4 days, just 4 days, and the same leader delivers two completely different messages, a shift so sharp that it signals something far bigger unfolding beneath the surface, because standing at the White House podium, the statement was clear and dismissive. We don't need it, we haven't needed it, and we don't need it, referring to the Strait of Hormuz, a passage many Americans rarely think about, yet just 4 days later, that calm dismissal transforms into a warning loaded with urgency. You'll be sound per open the strait or you'll be living in hell. Just watch. And the real question isn't simply why the tone changed. The real question is what happened in those 4 days that forced such a dramatic reversal, because that answer reveals just how fragile and interconnected the global system truly is. And it all points back to a narrow stretch of water that carries an outsized weight on the world stage, the Strait of Hormuz. A choke point only about 33 miles wide at its narrowest, sitting between Iran and Oman, yet despite its size, it handles nearly 20% of the world's oil flow every single day, roughly 17 to 18 million barrels moving through this corridor toward Asia, Europe, and beyond, making it less of a passage and more of a global pressure valve. And at first glance, the argument that the United States doesn't need this route appears grounded, in fact, because America imports only about 500,000 barrels per day through the strait while consuming nearly 20 million barrels daily. And even more significantly, the U.S. now produces around 22 million barrels per day, more than any other nation, surpassing both Saudi Arabia and Russia, which supports the idea of energy independence. But that's only part of the story, because oil doesn't operate within national borders. It trades on a global market where supply disruptions anywhere ripple across prices everywhere. And that's exactly what we're seeing unfold in real time. As tensions in the Strait escalated, oil markets reacted instantly. Prices surged more than 11% in a single day, climbing above $111 per barrel, a level not seen in 4 years compared to just weeks ago when oil hovered near $70. And that kind of spike doesn't stay confined to trading floors. It moves directly into everyday life, showing up at gas stations across the country where prices have climbed to around $4.11 per gallon, the highest since 2022. And this is where the broader economic impact begins to take shape, because higher fuel costs don't just affect drivers, they raise the cost of transporting goods, which means everything from groceries to construction materials to electronics becomes more expensive. Diesel prices increase, supply chains tighten, and inflation begins to accelerate, putting pressure on households already balancing rising costs. And economists have long tracked this relationship, estimating that for every $10 increase in oil prices, U.S. GDP growth can drop by 0.1 to 0.4 percentage points, which means a $40 surge could significantly slow economic momentum, and now projections suggest inflation could reach around 3.5%, effectively wiping out the average wage gains from the previous year, turning what seemed like progress into stagnation for many families. And markets don't just react to current shortages, they react to the fear of what comes next, and that fear is now centered on control of the strait, because despite America's production strength, traders and analysts increasingly recognize that Iran holds a critical advantage in this situation, not necessarily through a formal closure, but through the power of disruption, where even limited strikes on tankers or the threat of escalation has already reduced commercial shipping to a fraction of normal levels, slowing the flow of oil and amplifying uncertainty. And in response, Iran has signaled it may impose tolls for safe passage, a move that several Gulf nations have resisted, deepening the standoff and pushing the situation closer to a prolonged crisis, because even if the strait remains partially open, analysts estimate the world could still face a shortfall of 4 to 8 million barrels per day, a gap large enough to keep prices elevated and markets unstable. And this is where policy shifts become visible, as the United States moves from dismissing the strait's importance to actively trying to secure it, pledging naval escorts for tankers, offering insurance guarantees to shipping companies that lost coverage due to rising risks, and calling on allied nations to deploy their own naval forces, reportedly involving multiple countries, while also sending a clear message that those nations should take responsibility for securing their own energy supply. A statement that reflects both urgency and strategic pressure, and alongside these actions, a deadline was introduced, setting a specific moment for Iran to reopen the strait, raising the stakes even further. Yet despite all these moves, one major issue remains unresolved. There is no clearly defined exit strategy, no transparent roadmap explaining how this confrontation can be de-escalated or how control over the waterway can be stabilized without further conflict. And that uncertainty is what makes the situation particularly volatile, because history shows that many economic downturns are preceded by sharp increases in oil prices. And once those increases take hold, they tend to spread beyond energy markets into broader financial systems, influencing everything from investment decisions to political stability. And that brings us back to the central contradiction. The same waterway that was described as unnecessary just days ago has now become a focal point of global tension, not because its physical characteristics changed, but because the economic reality surrounding it became impossible to ignore. And that shift highlights a deeper truth about global power, that even the most dominant economies remain vulnerable to key choke points that control critical resources. And now the question moving forward is not just whether the strait will reopen, but how far this situation might escalate if it doesn't, and what that means for economies, markets, and everyday life around the world. So what do you think about this rapid shift and the growing tension surrounding the Strait of Hormuz? Share your perspective in the comments, because your insight adds depth to this conversation. And if you want clear, in-depth breakdowns of complex global events like this, make sure to subscribe and turn on notifications so you don't miss what happens next, because the coming days could determine the direction of this entire crisis. What makes this situation even more complex is not just the rising prices or the political statements, but the reality that control over the Strait of Hormuz is not defined by ownership alone. It is defined by proximity, capability, and willingness to act. And in all three of those dimensions, Iran holds a strategic edge that cannot be ignored, because geographically, Iran sits along the northern edge of the strait with direct access to key shipping lanes. And over the years, it has built a layered military presence that includes fast attack boats, naval mines, anti-ship missiles, and drone systems, all designed not necessarily to dominate a traditional naval battle, but to disrupt, delay, and intimidate commercial traffic, just enough to create global consequences. And that strategy is precisely what is playing out now, because even without declaring a full closure, Iran has effectively turned the strait into a high-risk zone where insurance costs skyrocket, shipping companies hesitate, and rerouting options remain extremely limited, because there are very few alternatives capable of replacing the volume of oil that passes through this narrow corridor. Pipelines exist, but they do not have the capacity to fully compensate for a sustained disruption. And this is where the pressure begins to spread outward from energy markets into geopolitical alliances, because countries that rely heavily on Gulf oil, particularly in Asia and parts of Europe, now find themselves exposed to a risk they cannot easily mitigate. And that exposure is forcing governments to make difficult decisions, whether to engage militarily, negotiate diplomatically, or absorb the economic shock. And none of those options come without consequences, because increased military presence raises the risk of escalation. Diplomacy requires concessions that may not be politically acceptable, and absorbing higher energy costs can slow economic growth and increase public dissatisfaction. And this delicate balance is what defines the current moment, where every move carries both immediate and long-term implications. And within this environment, financial markets are reacting not just to what is happening, but to what could happen next. Volatility increases. Investors shift towards safer assets, and companies begin adjusting forecasts based on energy price assumptions that were unthinkable just weeks ago. And for industries that depend heavily on fuel, such as transportation, manufacturing, and agriculture, These changes translate into higher operating costs and tighter margins, which often leads to price increases for consumers, reinforcing the inflation cycle that policymakers are trying to control. And central banks, already navigating complex economic conditions, now face an additional challenge because rising energy prices can force them to reconsider interest rate strategies, balancing the need to control inflation against the risk of slowing growth too aggressively. And this is where the ripple effects become increasingly visible, not just in economic data, but in everyday experiences, from higher grocery bills to increased shipping delays, creating a sense of instability that extends far beyond financial headlines. And at the same time, political messaging continues to evolve, reflecting both domestic pressures and international realities, because leaders are not only responding to the strategic situation, but also to public perception, approval ratings, and the broader narrative surrounding economic performance. And this is particularly evident in the shift we have already seen, where initial confidence gave way to urgency as market signals intensified, highlighting the direct connection between energy prices and political decision-making. And as alliances are tested, the role of partner nations becomes more critical, with calls for coordinated naval patrols and shared responsibility in securing maritime routes. Yet coordination itself presents challenges, because each country approaches the situation with its own priorities, risk tolerance, and economic dependencies, making unified action more difficult than it appears on the surface. And this lack of complete alignment can create gaps that further complicate the situation, allowing uncertainty to persist. And uncertainty, more than anything else, is what markets and systems struggle to handle because it prevents clear planning and increases the likelihood of sudden reactions. And as this tension continues, one key factor remains at the center of every calculation: time, because the longer the disruption or threat persists, the more entrenched its effects become. Supply chains adjust, contracts shift, and price expectations reset, making it harder to return to previous stability, even if the immediate conflict is resolved. And this raises a critical question about sustainability, not just of the current standoff, but of the global systems that depend so heavily on uninterrupted energy flow through a single choke point. And it forces a broader reflection on vulnerability, because despite technological advancements and increased production capabilities, the world remains interconnected in ways that can amplify localized disruptions into global challenges. And this is why the Strait of Hormuz continues to hold such significance, not only as a physical passage, but as a symbol of how concentrated risk can influence widespread outcomes. And as developments continue to unfold, attention remains fixed on both strategic actions and market indicators, watching for signs of de-escalation or further intensification. And in the middle of all this, your perspective matters. How do you see this situation evolving? Do you think it will stabilize through negotiation or move toward deeper confrontation? Share your thoughts in the comments, because understanding different viewpoints adds clarity to a complex issue. And if you want to stay informed with detailed, fact-driven breakdowns that go beyond surface-level headlines, make sure to subscribe and enable notifications, because the next phase of this story could reshape not just energy markets, but the broader global landscape in ways that are only beginning to emerge. As the situation approaches a decisive phase, the focus shifts from what has already happened to what could happen next, because the range of possible outcomes is wide and each path carries its own level of risk, starting with the most immediate scenario, a controlled de-escalation where diplomatic channels manage to reopen the strait without further confrontation, restoring partial confidence in the markets and stabilizing oil flows. But even in that outcome, the damage done to pricing structures and risk perception would not disappear overnight, because once markets experience a shock of this magnitude, they tend to build a premium for uncertainty into future pricing, meaning oil could remain elevated even after normal shipping resumes, and that sustained elevation would continue to influence inflation, consumer spending, and economic growth, creating a lingering effect that extends well beyond the initial crisis. And then there is the second scenario, a prolonged standoff, where the strait remains technically open but functionally restricted, with intermittent disruptions, higher insurance costs, and reduced shipping volumes. A situation that keeps pressure on global supply without triggering a full-scale conflict, yet slowly drains economic momentum across multiple regions, particularly in countries that are heavily dependent on imported energy, forcing them to either absorb higher costs or pass them on to consumers, which again feeds into inflationary cycles and economic slowdown. And this scenario is often the most difficult to manage because it lacks a clear resolution point, creating a constant state of tension that affects decision-making at every level, from government policy to corporate investment strategies. And finally, the most severe scenario, escalation into direct military confrontation, where attempts to secure the strait lead to broader conflict involving multiple nations, a situation that could push oil prices far beyond current levels, potentially toward $150 or even $200 per barrel, levels that economists have repeatedly warned would place significant strain on the global economy, increasing the likelihood of recession, disrupting trade flows, and introducing new layers of geopolitical instability. And this is why every statement, every movement of naval forces, and every market reaction is being closely monitored, because small developments can quickly alter the trajectory of the entire situation. And within this uncertainty, one consistent factor remains: the central role of energy in shaping both economic and political outcomes, because energy is not just a commodity, it is a foundation upon which modern economies operate, influencing transportation, manufacturing, technology, and daily life in ways that are often taken for granted until disruption occurs. And what this moment reveals is how a single choke point, just 33 miles wide, can exert influence across continents, affecting decisions in boardrooms, policies in governments, and budgets in households. And it also highlights the limitations of energy independence as a concept, because even nations that produce more oil than they consume are still connected to global pricing mechanisms that respond to supply and demand on an international scale, meaning no major economy is fully insulated from shocks like this, and that interconnected reality is what transforms a regional tension into a global concern. And as leaders navigate this landscape, they must balance immediate pressures with long-term strategy, addressing not only the current disruption, but also the structural vulnerabilities that allowed such a situation to have widespread impact, whether through diversifying energy sources, investing in alternative routes, or strengthening international coordination. Yet all of these solutions require time. And time is precisely what this situation does not easily allow, because markets react instantly while structural changes take years to implement. And this mismatch between short-term reaction and long-term adaptation is what makes energy crises particularly challenging to manage. And as we move forward, attention will remain fixed on key indicators: oil price trends, shipping activity through the strait, diplomatic engagements, and military positioning, each providing signals about the direction this situation may take. And for individuals, businesses, and policymakers alike, staying informed becomes essential, because the outcomes of this moment will influence decisions far beyond the energy sector, shaping economic conditions, political narratives, and global stability in ways that will likely extend into the months and years ahead. And at this point, the question is no longer whether the Strait of Hormuz matters. That has already been answered by the events of the past days. The real question is how the world responds to the leverage it represents, and whether that response leads to stability or further disruption. So how do you assess these possible outcomes? Which scenario do you believe is most likely, and what impact do you think it will have on the global economy and everyday life? Share your perspective in the comments, because your analysis contributes to a deeper understanding of this evolving situation. And if you value detailed, structured insights that connect global events to real-world impact, make sure to subscribe and turn on notifications, because as this story continues to develop, the next update could redefine everything we think we know about energy, power, and global balance.